Okay,
Hi,
cool.
Tim.
Hello, how you doing, Nicolette?
I'm doing very well. How are you?
Doing really good.
Awesome, awesome. Good morning to you. For our listeners, my name is Nicolette. I am the podcast creator titled You're Worthless. Read that again. The juxtaposition of your very soul. First up, I'd like to say thank you very much to you, Tim, for spending about an hour in the next couple of hours, 1 hour, okay, for our conversation today. And before we start, I'd like to read a bit of your introduction for our listeners today, and then we can get right into the conversation.
Okay, good. Thanks.
So, hello everyone. We have Timothy Clifford here with us. Tim's career began on the Chicago Mercantile Exchange floor in the 1980s, starting as a runner and then a trader, which gave him foundational knowledge of financial markets. In the 1990s, he joined Charles Schwab Co., where interacting with financially successful clients helped him distinguish between high earners and substantial wealth accumulators. This understanding shifted his focus from trading to wealth management. By the 2000s, he advanced into leadership, furthering his resolve to aid others in wealth building. In 2012, after becoming a certified financial planner, he founded Core Wealth Consultants LLC in Central Florida. This experience led to the creation of PlanAssist, a milestone in his career, aiming to simplify wealth building for those needing help with prioritization and organization. Ooh, a topic that is very dear to my heart because I am a chartered accountant myself. So, welcome, Tim.
Thank you. Thank you very much.
So, Tim, tell us before I'd like to take the listeners down a trip memory lane. What was it like growing up as Timothy Clifford?
So I grew up in central Indiana in a very small town. It was primarily a farm town, so 2,000 people or so, about an hour north of Indianapolis. So right, literally almost in the central part of Indiana. And it was, there wasn't, the farmers had money, but for the most part, it was a period in time where we made okay money, but it wasn't a period where you had excess wealth. Is maybe the best way to describe it. So it was enjoyable. I mean, you don't know what you're missing when you're so it was a good growing up experience. When I got out of high school, though, I really was driven to how do I build financial independence. And I don't mean it just for like, it's not so much I want to have $1 million so that I have $1 million. It was more, I want to have money so I can have financial independence, so I can make decisions when I want to make decisions. It's not a company doing it. It's not a boss doing it. It's true financial independence. So I was very driven by that from a relatively young age. And
Mhm.
that's what kind of led me down the path of back in the 80s. One of the places that people made a lot of money without kind of starting with money was in the commodity business. And that's what led me to Chicago. And I moved to Chicago and started my career in the commodity business.
Mhm. So I was reading a profile on Podmatch, and there's a statement there: making money does not equate to having money. What do you mean by making money does not equate to that, to having money?
So so as I've read as I've built out PlanAssist to make this simpler for people to understand, one of my really big ahas, which shouldn't be an aha, it becomes pretty obvious when someone points it out. There's a lot of people that make a lot of money over long periods of time. And at the end of that period of time, they don't have very much money. I mean, if someone's making, if you have a household making, just think about it like this. If you have a household making $150,000 a year, which is a high income, but even at 100,000 a year, so two income household,
Mm-hmm.
that's 100,000. So that's somewhere between 1 million and 1.5 million in income over a course of just 10 years. And we all know lots of people that at the end of 10 years making that money really have no money. That they don't, are no real net worth. And
Right.
so that's what I mean by that is we have to get better at making sure that we don't get sucked into I'm making good money and at some point in the future I'll start saving it and investing it. We have to start now, and start earlier is better.
Yeah, there's this quote saying that the best time to start was 20 years ago. The next best time is right now.
That's right.
So it's never too late, right? And then
That's exactly right.
yeah, so for the benefit of our listeners as well, the way we connected was that I am also an avid learner from Tony Robbins, and as I've been following his teaching since I don't know 2012, and you yourself as well. So can you share with us, like, I know there's this hoo-ha about we people need to know what to do, but then what exactly do they need to be careful about when making financial decisions or investing?
So first is vision, right? So we got to kind of have an idea where we are. So what I've done is I've simplified the process into 3 steps. So think of it from 30,000 feet. Someone has to have a plan. So you got to know kind of where you're at first, and then where do you want to go. So some kind of a plan, which we'll touch on and get into a little more detail here in a minute. The second thing you have to do is you have to be diversified, and meaning you can't just put all your money in one thing, because what happens if the one thing doesn't work out and then you've lost everything, right? So diversification, but even that's more art than science. But the second piece is diversification and some kind of a diversification strategy. And then the third is seek counsel. And what I mean by seek counsel, it does not mean call some salesperson and get sold a life insurance policy or a car or something like that. Too many people think going to or talking to financial professionals is the equivalent of going to a dentist, right? They absolutely despise it. And so it is very challenging for someone who's making a lot of money, which obviously if they're making a lot of money, they're really smart, right? And they're very driven, right?
Mm-hmm.
So then that they just want to go on and do searches on Google and get those answers the second way. The third piece of that
Yeah.
kind of step
Mm-hmm.
is seek counsel. But that's the hardest of the three. The first two
Yeah.
are somewhat what I would call kind of objective. The third one is very difficult, which is probably where we can and will probably spend the most time because it's so subjective.
Mm-hmm. And it's subjective because it depends on your appetite, your risk appetite, and the how long are you looking at when you're investing on something, right? And also, I think, in my opinion, my humble opinion, it's about whether those people are acting in the best interest of those that are coming to him or her for their services, right? And I because to me, I think of it as, okay, coming back to the part where you said high income earners after 10 years they don't really have much net worth, and that's because of what, their lifestyle or just poor choices of investment vehicle.
It's it's probably both.
Mm-hmm.
So seeking counsel you hit on a whole bunch of stuff that I actually
Sorry.
do touch on in the bank. No, that's good because I hit on all those things in the book because it is so difficult to make sure you're getting advice from someone who's not biased, so they don't have an interest. YouTube is terrible. People think, oh, I'm going to go get financial advice from YouTube, but they don't realize you do as a YouTuber. You get paid a lot more money for financial advice than you do, say, a how-to video. And so a YouTube video on financial advice automatically is biased because, well,
Mm-hmm.
why is that getting paid more? Well, it's the advertisers, it's the marketers, it's access to people who are listening to it. So the point of bias, but to answer your question on kind of why is it at the end of 10 years, someone's made, let's just say $100,000 a year for 10 years. That's $1 million, right? At the end of
Mm-hmm.
10 years, they have none. It's not that they made bad financial decisions. I'm not going to say people don't make bad financial decisions because some do, but for the most part, people are pretty good. It's just, can you make better financial decisions? And it's little tweaks here and there when people are making financial decisions. And when it comes to getting advice, it's more people that don't have money are not used to seeking counsel because they probably made their money themselves, right? And so they have this ego, this I can kind of do it myself. I'll go find my information. I don't want to be sold something. People with money, people who grew up with money. So go into your own circle of influence for people. People who have had money or are built on money, those people have all kinds of, they have a circle of advisors around and they don't
That's so
think
true.
twice about
That
using
is
it,
so true. Yeah.
right?
Yeah.
I mean,
Hmm.
so people that just make money, we'll go and sign contracts, we'll go lease cars, we'll go do all kinds of stuff, right? I mean, we'll sign, 30-page contracts and think nothing about it, right? Lease a house, all kinds of things. And someone with money will almost always run that past an attorney, as an example, right?
Mm.
So this
Mm.
isn't about, we think it's being sold because the people we seek counsel from have a tendency to be salespeople and have bias. When in
Yeah.
reality, we want to build a circle of advisors around us who
Trusted
aren't trying to
network.
sell us. That's
Yeah.
exactly right. And who
Yeah.
aren't selling us, who are just giving us input, and then we'll decide whether
Hmm.
we're going to follow it or not. We'll completely make that decision. It's not like a lot of my clients, they'll come and say, well, what do you think about this or that? And I never say no. I don't say you can't do this or you can't do that. I always try, almost always, I try to stay at kind of yes, but, and then I try to explain how that decision impacts other parts of their financial plan. And then they decide, right? It's their money. I'm not trying to sell them on do something or don't do something. I'm just trying to inform them, and then they'll make the decision. But I find most people are very capable if you give them, not most people, almost everyone that I've worked with are more than capable. People know what they do, know what they should and shouldn't do. You just have to inform them.
Yeah. And to be aware, because yeah, like you said, people know what they're doing. They know that
Right.
if they're spending, say, Starbucks every day, they know that it's gonna eat up the net worth at the end of 10 years,
That's right. Exactly.
compared to somebody who's buying coffee, buy the groceries, and just making them themselves at home. I too am guilty of taking Starbucks once in a while. So
But again, we don't want to live, if we're making $100,000. I'm not I'm not saying we should live on beans and rice, and so we should
frugality
live our
mindset.
lives, right? Because to your point, the whole reason of this podcast is you're worth, you want to live your life and spend your money. It's just you got to put some rules in place for yourself and for your significant other, because a lot of times one person will be a spender and another person will be a saver in a relationship, and they
Yeah.
don't really talk about how to do that. Well, the way you do that's a plan.
Hmm.
And that's why you don't fight, right? I mean, because here's the plan. And what a plan does is says it helps you say no. It
Mm-hmm.
helps you, what I mean? Because now when you have that emotional, I want to buy this car, it's either in the
Yeah.
plan or it's not in the plan, right? And it's not
Yeah.
this fight with your significant other.
Mm-hmm.
Does that
Well,
make
thank
sense?
you. Yeah, thank you so much, Tim, for taking the time to
Sure.
explain to me. Like that was me thinking out loud. And as a millennial myself, like, I try, like you. I also, I came not from a well-off background. You know, education is key for me, so therefore out there trying to hustle and grind and trying to make achieve that financial freedom. Yeah. And I'm very grateful to be able to be talking to you right now, and my education has definitely helped me to get to where I am right, have that confidence even to be talking to you. Wow, like, yes. So yes, I just want to express my gratitude. So, Tim, can you share with us an overview of your book and what inspired you to write it?
So the overview is kind of built on the 3 points we touched about. Have a plan, be diversified, seek counsel. So I'll go through each one of those just very briefly, and then maybe we can hone in on one or two of them or use some examples. But the have a plan does not mean you need a 30, 40-page document of kind of every piece in your life. Okay, what it means is you need to have a clear view of where you're at right now. So I am here, I'm making $10,000, I'm making $5,000 a month, I'm spending $3,000 a month, whatever that is. And then, okay, where do you want to go? Okay, and have some kind of vision of where you're trying to go, which is completely Tony Robbins. I mean, in the sense of you have to have a goal and you have to be focused on what you want to do. And then kind of start building it. Now, the plan though, that's the fun part. So if anyone's ever built a addition onto their house, they've experienced this process, okay, whether they realize it or not. And what I mean by that is when you build an addition on your house, the first person you probably seriously have a conversation with is going to be the architect, okay? Now, the architect is usually a fun conversation because that's like, I want it to be this, I want the roof line to be this, I want the ceiling this.
The tiles.
So that's a fun, exactly. That's a fun, good conversation, okay? But at some point, that conversation will turn to the engineer. Okay.
Mm.
And the engineer will then take all that information that the architect's made pretty and fun and put it into a CAD system. Okay. And what that CAD system will do is it will connect all the dots. Okay. So if there's a wall that's 20 feet long, as an example, and a ceiling and there's no pull, the engineer will look at that and say, hey, this is a problem. We're either going to need to put a pole at 10 feet in the middle of your room, or we're going to need to use a steel beam to make sure this ceiling doesn't come down. If you do the steel beam, that's going to cost you X. So what do you want to do? You want to make this room a little bit littler? Do you want to add a pole? Do you want to use a steel beam? Just as an example. And that's not fun, right? Because that's like, oh my gosh, you've just added $3,000 to my $50,000 project, you're right.
Mm-hmm.
But think of like doing a plan is similar to that, right? And so it starts with kind of, well, where are we at now? Where are we at? Where do we go? How much are we spending? What tools do we have to help us build wealth? 401ks, IRAs, those types of things. But then at some point, you do want to put it into some kind of a software system where it does connect dots so that you get good at, over the course of years, decades, connecting how one financial decision impacts another financial decision. Because that's probably the one thing that I see people who are successful, that's the biggest mistake I see them make. And it's very benign. So you don't notice it because you're making a decision, like I'm going to buy life insurance. Okay, well, that's great. So they'll actually make a very good decision buying life insurance. And then on who? They'll make a good decision on a house. They'll make a good decision on 401k. How much do I put in my 401k and allocate? But really, at some point, you want to connect all those dots, and that's what I'm really talking about when I do planning. So that's kind of doing a planning, and I'll give you one very fast story on the connecting the dots. And this probably doesn't connect everyone in the audience, but you'll get the picture. So I sat down with a couple. They were early 30s. They had 2 kids, out of debt. They did kind of the Dave Ramsey model where they were kind of paying off their debt as they went. They had their little buckets of money. Fabulous. We're doing really, really good in kind of saving money and everything. And I got to the section of like in a normal plan, you get to, okay, well, how are we doing on life insurance? That's a good example. So I got to the life insurance discussion. And I said, well, do you have life insurance? And they'll say, yes, very proud. Yes, we have life insurance. We have $1 million on, I'm just going to make a name up, Joe, right? So I have $1 million on Joe. And I said, how much do you have on Sue? And they said, 0. We don't need it on Sue because she doesn't work, right? In the workplace. Obviously, she's raising the children, right? So she works at home, but doesn't have a job outside the workplace. Mm-hmm. So when they got done with that, I said, you guys realize you have that flip-flop, right? And they said, what do you mean? That's what we've been told. I was listening to all these advice on the, general advice, right? So that's like dangerous counsel. Someone will say, I'm getting counsel because I listened to so-and-so, I read a book. That's general counsel. So when I'm giving advice, even right now, it's general counsel, right?
Yeah.
It's not specific. So I tell people, you have to really sit down. I have to understand what you are to be specific. And in this case, I said, you are. So I looked at her and I said, you're a trust baby, right? And she started laughing. She goes, well, yeah, but and I could tell because it was an hour long. I could tell just how they were talking. They weren't taking money from her parents. They were very proud of that. Um, but it was very obvious that she was raised and her parents had substantial
And an
means.
affluent upbringing, right?
Very obvious, right?
Mm-hmm.
Okay.
Mm-hmm.
So I said, okay. I said, so in this example, I said, what happens if Joe dies? I said, money wise, I said, does it really matter? And she literally started laughing. Said, no, it does not matter. Okay. I said, exactly.
That's a
I
good
said,
one.
I
That's a
said,
good
your
one.
parents are going to show up and they're
Mm-hmm.
just going to show up and write checks, right? It's not going to be a big deal. It's literally not an event. Financially, huge event. Emotionally, obviously,
Mm-hmm.
love, obviously, but financially, zero event. She literally said, that's right. I said, what
Mm-hmm.
happens if you die? I said, big problem. And she said, yes. I said, it's not that they're not going to take care of the children because they are, but they're not giving Joe tons of money. They're not giving her husband complete access to the
Mm-hmm.
family fortune, right?
Mm-hmm.
And she said, that's exactly right. And I said, that's what I mean. I said, so you really should have, I'd leave the $1 million. It's relatively inexpensive for you, but I'd definitely add a million or two on you, okay,
Mm-hmm.
just to go through. That's my example of probably a little bit kind of out there, doesn't apply to most people, but the analogy understands specific advice is important.
Oh,
Okay, so that's a plan.
hits so many points. Tim,
And and
I
then
love it.
and then the second one, which I'll just touch on very briefly, and then the next one is diversification. You want diversification across investments, but you also want it across tax liability. So you want tax-free, taxable, tax-deferred. So when you get into retirement, you
Mm-hmm.
have some control over your taxes because that's one of your biggest expenses when you get into retirement. So having diversification from a tax perspective is very important. The way you do that is you have money in your Roth IRAs, you have money in your regular IRAs, you have money in your outside. And then the third is seek advice. And advice comes in two forms. It comes in formal and informal. And we're really good. Most people are really good at informal advice
Mm-hmm.
and taking informal advice. But it's important that we realize it is informal advice, and informal advice is different than formal advice. Formal advice will have a tendency to be um, sleepy and boring, etc., because you're paying for that advice. But informal advice will be your neighbor. It'll be, um, you know,
Which is bias, which can be bias.
it's
And
very
yeah,
well. It can be even formal advice can be biased, right? I mean,
that's true.
bias becomes part of the process, but you kind of need to understand the difference between the two. But they're both good. And
Mm.
I actually touch on this. It's not that one's more valuable than the other, but you do have to understand that this person's giving advice is not. It's just flippant advice for what they think matter, and it's good advice to take into consideration. But if you're paying for advice, it'll have a little different flavor to it. So
Yeah.
that gives you kind of a high level view of each of the three.
Mm-hmm. And it's like when a person, whether it's paid or not paid, giving advice, they all come with their own experiences and the knowledge, which is kind of limited based on the years of experience they've been in that industry or giving advice to people. So it is important for those seeking advice to also have apply their own discernment. Right. Take the advice from, sorry, when I say take, meaning you can listen to the formal and also informal and then sit down and then have a like a balanced view on both sides, and also sit down and with yourself, like, are you really, is it aligned to what's your planning that you want to look like your in your financial freedom, you call it independence, right? And yeah, but again, most people are not really thought that way.
Yeah, that's right.
Yes.
It's not
Yeah,
natural.
it is not natural.
Like,
Oh, okay. I think we touched about this earlier. Tim, can you like share with us again, give us a brief breakdown of what are some of the common mistakes people make when it comes to financial decision making?
I think there's three. Okay. The first one is obviously they live outside their means. Okay. So
Ooh,
that's easy to do, right? I
ooh,
mean, and that's probably the biggest, and it's the most obvious, and that's probably the most common is people,
mm,
basically spend more than they make.
yeah.
The second big mistake that I see people make is they don't max out their retirement options. So some people have a 401k or they'll have access to an IRA account and they're not maxing out those contributions on an annual basis. So I'll meet people who will be making 100,000 a year working at one of the Fortune 500 companies and they'll be putting 4% in their 401k. I'm like, why are you putting 4%?
Right. The
Why
401k,
not 10?
because that matches the employer matches the contribution, excuse me, the contribution of the employee. Is that correct? Is that how
Correct.
401k works? Okay.
And what'll typically happen is the person will do whatever the employer matches. So the employer probably
Ah,
won't match 10%. The employer will match 4, right?
yeah,
So they'll say, okay, I'm
yeah.
going to put 4 in, and then the employer puts 4 in. That's really good. So that's a good start. But they should be you can put 20 plus
10,
thousand
20.
dollars into a 401k.
There's no cap for
Yeah, there
the.
is. It depends on your
Okay,
age, and so if you're over
okay.
50, it's like 30,000. There is a cap, but it's in the 20 to 30,000. But most people don't even come close to the cap. I mean, and
Because
and and lo- and then those of us working kind of part for ourselves, we're 1099s, we're soloists. We're not even doing our max IRAs, right? So we can do $6,000-7,000 in an IRA. So that's the second big problem. That's the second mistake that I see people make, and I'd put that as number 2. But it's relatively simple to fix, but lots of people make that error. And then the third, I think, biggest mistake people make is they think their houses are investments.
ooh, thank you, Tim.
So,
Because I
so
am
I
one, I don't know what's the percentage, but I used to think that it is um a must have. Like, okay, not to say that I don't have, but I have a house, but it's not like a million, or it's not 500,000. I'm talking in ringgit terms because I'm from Malaysia. And I don't know, millennials, especially here in my country, they are so tied down to the notion of, okay, I need to have a house. So I'm earning so much. I mean, comparatively, let's say 10,000 ringgit, and you're open to you're taking up a loan of 1 million, for example, and then some may max it out to 800,000 or 600,000. So, and it becomes heavy. Your debt service ratio shoots up like through the roof, and that's just a house, you know. But
exactly.
yeah,
House is someplace you live. I'll sit down with people. Well, it's interesting if they've never used a financial advisor. As a financial advisor, we even in the tools we use have the ability to say don't count the house in the balance sheet or in the thing, and it
yeah,
drives
unless it's
so
paid
many
off.
people. Even then, you can't really count it. It's
Oh,
not
because
an
taxes.
investment. Well, it's
Ah.
because you have to buy someplace. You got to live someplace. Doesn't count as investment. You
Mm.
have to live someplace. So if I have a $500,000 house that's paid off, doesn't matter. If I sell that house, well, okay, I might be able to go to a $200,000 house, or a 300,000 or 400, but it's still an asset that you have to use. It's not an invested asset. It's different than, say, your 401k or your investments assets or your savings account. It's not an investment. Is kind of the point to take away. And most people think of it as an investment. But it's not.
But Tim, what about if you have the house paid off, rented out to people, and then you yourself is renting somewhere? That
No,
is a
that's different. Then the house is an investment property.
right. Okay. Okay.
But
Okay.
most people don't have that. That's the exception, not the rule. Most people are
Mm-hmm.
living in their house. If you're living in it, and not renting it, it's not an investment. I
Mm-hmm.
mean, it's not an investment if you're living it.
Understand.
I know, I can see it on your face. You're like, no, how's that a house? I'm telling you, it's more now what a house can be when you put together a financial plan. This is why you want to be very careful. Even the advice I'm giving now is general, and think of it
Mm-hmm.
as informal. When you sit
Yeah.
down and do a very specific plan on yourself, you're going to find out that it becomes very specific to your situation. Now, where a house does play a role in a financial plan is if I'm doing a plan on someone who's 65, 70, we will include the house in the estate plan. Like they'll say, well, I want to leave my children $200,000 or $100,000. Okay, great. How much is the house worth? And we'll
Mm-hmm.
include that in end of life, right? So we can spend all the money in the investment accounts because we're going to have the house to give to the children, and that's going to be part of their estate, right? So there's ways the house could be included in a financial planning process, but it's not. I have a house that's worth 500, and I'm going to put all my money into a house, and I'm not going to put money in a 401k. I'm not going to put money in investments. I'm not going to put
Mm,
money in savings. I'm not going to put money in
yeah,
my retirement account.
that's
That is
right.
a huge mistake.
Mm-hmm. Mm-hmm.
So
Because
that's the third
everything's,
mistake.
yeah, because everything is tied to the house, nothing else.
That's correct. And lots of people do it. I mean, it's very easy to do. You can get into some really, really affluent neighborhoods, and those
Mm-hmm.
people, for the most part, have spent all of their money on that house, right? They may
Mm,
have good jobs. They may make a lot of money. They don't have any money outside their house, and because they see that house as their investment, and it's
yeah.
just not.
Well, it's interesting. So it's actually it's similar to what's happening in Malaysia as well. I
Do
love
you
it.
guys What's the real estate in Malaysia kind of like? Is it similar to the US or not so much?
Yeah. So I would say the concept is the same, like what you mentioned, the common misconceptions, same thing. People, some of them are seeing houses as the investments, but then some are educated. How do I say? Not educated enough, but they are more informed that okay, there are I guess this is split millennials that are looking at buying properties just for investment, but then and they they take that as the primary investment vehicle, buying a few houses and flipping them and getting that. So we have that, but we also have those at least one house they've already attained certain salary range that allows them to buy a house that is suitable to their income level. Most of it, 50% of their net income goes to that house, in which at the time they probably will be renting still and then paying off. Sorry, when it's still in building stage, pay it off and then they move into the house. And then the some of it's purely they don't look into houses at all. They're just like myself. I'm
They
into
just rent.
renting. Like, yeah, I just
Yeah.
rent. And and it's, to be honest, it's easy because I calculated. I'm like, you know what? I don't like to be tied to 30, 35 years. But again, I'm going to put a disclaimer in this podcast, in this episode, because this is not an advice. It is just an opinion tied down to 30, 35 year um, l- length of loan. That's pretty much the real estate in Malaysia.
Okay.
Yeah. But the concept is almost the same, like you said.
Okay.
Yeah. Yeah.
That disclaimer is important though. None of this is advice.
Yes, exactly.
It's
Exactly.
just general knowledge, information that people should do their own research and make their own decisions.
Mm-hmm. Mm-hmm. Um, Tim, what about now? You're a CFP. What are your thoughts on fee on the different investment vehicle? that are out there. Sorry, investment. Yeah. Yeah. Vehicle. Yeah.
So I don't know how Malaysia does fees. We have kind of three ways that we do fees in America. So we have like just regular commissions. So kind of, fees, that, buy and sell costs you $50, $100, whatever the number is, right? That's
Right.
probably similar right there, right? I would suspect.
Mm-hmm.
The second is account fees, and the third, so just, we charge you $100 to have an IRA. You guys probably have an equivalent of an IRA,
Yes,
some
that's
kind of a
correct.
retirement account. And then
Yeah.
and we'll charge a fee to have that account. And then the third is we'll charge a fee for advice. So it's a lot of times it's set up as a percentage of the fee. So we'll say
Mm-hmm.
if you have the equivalent of $100,000 in America, what would be a common fee would be 1%. So we'd charge you $1,000 for that $100,000 investment a year. So, and usually it's charged quarterly. Those are kind of the three common fees. But we can get into a whole podcast on fees because
Yeah,
that's
I
where
love it.
bias becomes,
Yeah.
right? I mean, so as an investor, it's important to know how someone's getting paid, and that person should not hide behind it. It's fine that they're getting paid. Obviously, we
Mm-hmm.
want people that we're using to make money or utilize their services, and they should be paid a fair amount of money. But that we should know all the fees and how they're making money, and it should be
Yeah.
very, very transparent.
Mm-hmm. Same like auditors.
Same. Exactly.
Yeah.
No, it should be very transparent and fees. So you should know exactly all the fees and how someone's getting paid when they're being paid. So I don't know what's kind of normal fees in Malaysia, but here it's kind of 1%, and then
Similar. Yeah, but I guess what I'm trying to get up across and also to our listeners is the fact that the importance of looking at the fees that you're paying, whether you're going into unit trust or wherever, that because significantly that amount can erode your value at the end of that 10 years. I mean, you can have the best plan as well, but then if you're not looking at the fees, like the institutions that providing those services, unknowingly you're so confident that you're gonna get, I don't know, 5 million, and then you'll see, oh, it's only 800,000. How come? Yeah.
right. So you do have to balance. So that's where seek counsel comes, right? So the third of the
That's right.
three, you've
Mhm.
got to really think through how much are you paying, but you don't want to be so crazy that you don't pay for any advice, right? Because you can go, because that's your DIY, that's your do-it-yourself person, right?
Yeah.
So this person says, I'm going to do it all myself. I'll go on Robinhood and do my investments. And so they spend nothing on fees, but they make lots of mistakes or they overpay for fees. So again, it's kind of a balance. But probably the best strategy is just balance.
Mhm. I love it. Thank you. Thank you, Tim. So, Tim, what role does mindset play in making better financial decisions, and how do you address this in your book?
I think it's probably the vast majority of. I mean, I think mindset's super important, and understanding that you don't become obsessed with the money. Money is nothing more than a measurement of how much value you're adding to different people. So you don't want to think of money as this, oh my gosh, I'm not going to spend $5 to go to Starbucks because of da 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 da, or you're working with, because remember that can affect all of your life, right? It affects, everyone starts calling you
True.
cheap, or you go through a process. You got to think, you want to be confident in kind of what you're doing and income, and kind of build within your means, but at the same time build balance, kind of what is your money doing, and it's buying you financial independence. And so that
Yeah.
doesn't mean that money is not going to go up and down, and you're not going to make investment mistakes and those types of things. But again, if you're diversified and you're doing small amounts, you're learning each time you go through it. But building a net worth, and understanding how those decisions impact other decisions, are all mindset. It's all mindset. I mean, you can't underplay the importance of having a good mindset, but it needs to be a healthy mindset, right? It can't be this kind of obsessed about.
Obsessive. Yeah.
Yeah, it can be, because then it's unhealthy, right? I mean, so
Mm-hmm.
you've got to find this balance of, money is not there to making money is for a reason. It's financial independence, but it doesn't replace happiness, relationships, and all the other pieces of life, right? It just enhances them.
Mm-hmm. Mm-hmm. I love that. That I think we came full circle. I love it. Okay, Tim,
I agree.
for yes, for listeners who might be feeling overwhelmed by their financial situation, what advice do you have for getting started on the path to making better financial decisions?
Just start with a plan. Just start with, like, it can be as simple as one page. Make
So
$5,000 a month,
much. Mm-hmm.
$4,000 a month, and we're spending. If people haven't done this, they'll probably find out they're spending 6,000 a month. And so how do we get that to 3,000? That's where I would start. You don't have to make this really complicated. It can be as simple as kind of, well, where are you at now? How much are you spending now? How much are you making? And then kind of what's the difference? And are you taking advantage of some of the ways to save money that's available to you? Because again, that's different for everybody, right? It's different from country to country. It's different from company to company, et cetera.
Mm-hmm.
But utilize those ways to save money. People have lots of ways that they can actually save money, and that's important to utilize those, but lots of people don't.
Thank you. What is next for you, Tim?
It's more of this. I'm continuing to work on my PlanAssist model. So how do I make that, more available? How do I automate it more without taking the person out of it? I know everyone's kind of talking about, okay, well, we can just do it all online and do it, with AI and all that. And I'm like, yeah, I really want to leverage AI. I want to leverage the automation of a plan, be diversified, and seek counsel. But at the same time, I want to make sure that people understand the value of a person. And so that's really what I'm continuing to work on. I'm kind of in the early phases of that process.
Mm-hmm. And then this plan assist is the program that you created yourself.
That's correct. Exactly. And you can get information even in Malaysia. The basics are pretty uniform across the world. I don't go into super detail on any of these, so you can customize and personalize based on your experience. I go into enough detail. The book's only 50 pages, so this is not some textbook that you're going to kind of spend 4 weeks reading. Okay, it's relatively easy, but it kind of just hits on the concepts at a
Mm-hmm.
high level is what it does. And so, but the concepts are really important. And then the philosophy is kind of based on, and this goes to Tony. So the
Quoting
very
Tony
first
Robbins,
philosophy,
I really hope
well,
he sees this podcast some
yes,
way or another.
yes.
Can give
So
us
so
two
so
tickets to his event. I've been
so so,
wanting
so,
to.
so
And
exactly. And so one of the things that I was in a meeting and someone gave Bill Gates, he said Bill Gates said this, but I've always known Tony Robbins to say people are absolutely shocked by how little they can accomplish in 1 year, but how much then they can accomplish in a decade, right?
oh,
So too many people think in terms of like, okay, well, what am I going to do in a year? Wait, not much. Okay. I mean, you can get things rolling, you can get some action going, but you will be absolutely shocked at a good strategy plan that you're executing on over a decade. It can change your life. Okay. So
exactly.
so the first philosophy that I have is financial independence or financial success is not an event. It is the accumulation of all those financial decisions you make over decades. And
Mm-hmm.
then
Mm-hmm.
how do you make better financial decisions, and how do you do that? And how do you spend enough time to make sure that each of those decisions, though it may not seem important, the accumulation of those decisions has a massive impact over a long period of time, right? So that's number one. The second one is we're not going to take advice from anybody that we don't already know the advice. So if someone comes to us and says, you need to do this or do that, if we don't already kind of understand that advice, or we don't already have internalized that information, we're not doing it. We don't realize it. But if someone comes and says, go do this or go do that, if we already are already close to there, and this goes to Charlie Munger, is things that we almost know we'll do, but things that we don't, we're not. And so
Yeah.
the book's kind of built on those kind of two philosophies, and then the three principles that we touched on.
Mm.
So
Wow.
that's my summary. So
Thank
but
you,
again,
Tim.
and then just to kind of summarize, anybody can do like financial independence over a decade or two is definitely doable, but it does take some strategy, some thought, some, how do you kind of go through that process? And that's what I've really tried to do with PlanAssist. I've tried to say, okay, I'm not going to get into kind of the minutia of doing it, but at least at a high level, here's some things that you have to pay attention to. And those are the things that I found people that have accumulated substantial assets, they all use those. They all use what I kind of lay out in PlanAssist to some degree, right? Almost all of them, and they may use them in different words, but
Exactly.
they almost all
It's
use
like
them.
they almost all of them will have a plan, something.
Yes.
Yeah.
They'll all be
Strategize.
diversified. They'll always have. They
Exactly.
don't have everything in one place, and then they'll all use counsel. You're right. So
Precisely.
they'll
Yeah.
always have professional people in their lives, right? And if you look at people who don't have assets, they'll miss big chunks of that.
Yeah.
So
It's never too late
anyway,
for our
no,
listeners.
right?
Yeah.
Start now.
Start now. Okay, Tim, I'm going to pivot to a self-worth question because my podcast talks a lot about that. So, the question for you, how do childhood experiences and upbringing impact an individual's sense of self-worth and their ability to engage in self-discovery later in life?
I think our childhood experience definitely have an impact on what we value and then what we strive for and are willing to pay huge price to get, right? So for some people, it might be, if they grew up poor, they might want financial independence, right? If they grew up, in a small house, they might want, other things. So I think I guess to summarize, I think your childhood experiences can have a big impact on kind of what we find is important as we get older, and have an impact on kind of what we strive for.
Thank you. What is your heart's greatest wish?
To just make a difference. I mean, make a difference in people's lives in a positive way. I mean, so I think that's probably the
Thank you, and you're doing
biggest
great work.
difference.
I love
Yeah,
it.
I mean, and I want people to, and I don't even need to be attached necessarily to it, but I want people to kind of whatever is important to them. Some it is financial independence, others it's not. So whatever
Yeah.
it is, I just happen to have the gift of financial side of it, so I'm trying to do my part in that genre or that area.
And thank you for that tip. Do you have a mantra that you live by?
My mantra is just get started. I mean, and this is my kind of mantra is act as though everything depends upon you and pray as though everything depends on God. Right? So that is my mantra. And it has been since I was in college. So it's not this sit aside and hope things happen. It's act as though everything depends on me and pray as though everything depends on God. That's my mantra.
I love that. What keeps you up at night? Is there anything that keeps you up at night, or do you sleep well?
I sleep pretty well because again, with the have a plan, be diversified, seek counsel. I follow that advice, and I do
That's
it.
a good one. So you can sleep well.
So I relatively sleep well. I mean, I worry about I try not to worry about things I can't impact, that I have no impact on or I can't change, right? So the things that I can control, I really try to control those things. And then the things I can't control, I try not to overthink them.
If you could create a quote right now for you to leave to the audience listening and the world as your legacy, what would it be?
That's a difficult one. I would say, and I touched on it a little bit. I'd say, financial success is not an event. It's the accumulation of decisions you've made over decades.
Thank you. So, Tim, how can people reach out to you?
PlanAssist.com. But I am only registered in 3 states in the U.S. You can actually go to Amazon and buy the book. So it's PlanAssist.com. But PlanAssist.com is kind of my information. But the financial services business is very regulated. This is general advice or general information. It's not advice. Like me being able to help someone in Malaysia is probably unlikely, right? So because of licensing and regulations, right?
Right.
But they can go read the book and go, download the information and kind of then build it around themselves.
And
that's where they can get in contact with me. They can send me an email. I'm happy to answer. Kind of here's something to think about or something to consider.
So they can do that through Amazon. They
Exactly.
can get your book through Amazon. Okay.
Yep.
All right. And you mentioned you're only registered in 3 states, so I thought like if you're a CFP holder, that's automatically you are licensed to give service to people across the country. No.
You still you still get licensed and regulated by state. So some people will will do it across, the country. Some will do just specific geographics. And I do more like where are most of my clients? I live in Florida, so I kind of use Central Florida. There's a lot of people in Central Florida though, so I have more than enough people. But no, there are some regulations that kind of dictate who you can help. It's not that I can't talk to people though, so I don't want to kind of downplay. I'm not licensed in other states, but I can help or at least, forward. That's one of the reasons I wrote the book, because the book does give people, kind of some general advice or general direction that can be really helpful. And again, I've been doing this for 25 years, so the book's kind of based on what I see people with money do.
And I'm sure those that are listening to this podcast right now will gain something, at least something. Yeah.
Yeah, exactly. Yeah, if they get one thing, a lot of times that's what I find valuable. If you can get 1 or 2 good ideas from something, it can make a huge difference.
Exactly. And there you have it, guys. You heard it from the person himself, Tim Clifford. Before we close off, Tim, I'd like to thank you personally for the work that you are doing for the world and for advancing every step of the way despite the challenges, creating trails for those that will come after you. This has been that one podcast with that controversial name, You're Worthless. Read that again, the juxtaposition of your very soul. If you find yourself thinking that you are worthless, probably you're not alone, but more importantly, ask yourself a level deeper. If I'm worthless, then why the heck am I here? It is because your soul have chosen to be here energetically all the way from the ethers, and for that reason itself, you are worthy and you are enough. This has been Timothy Clifford, your guest of the day, and Nick Nieras, your host, signing off. Thank you. Thank you again.
Thank you. Thank you so much, Nicola. It's been really wonderful.